What's up guys, and welcome to WSM Research. Before we get into the video, keep in mind that we are not financial advisors and this video is for entertainment purposes only. Make sure to consult with a financial advisor before making any investment decision. Today we're talking about a high-flying biotech stock which has the potential to revolutionize the medical industry. This is an early stage company and is highly risky as an investment, but if everything goes right, this could be like investing in Amazon in the 90s. The stock we're talking about is Intellia Therapeutics, ticker symbol NTLA. Intellia is using CRISPR gene editing technology to cure a wide range of severe diseases. CRISPR allows scientists to alter the cell's DNA, completely transforming the cell's functions. Altering cell DNA can be used to change the characteristics of a wide range of organisms. For example, gene editing has been used to create mutant jacked cows. But the real potential of this technology is to alter human DNA in a way that cures or prevents human disease. Total healthcare spending is $3.8 trillion in the US alone. So there's an almost unlimited potential if they can make their CRISPR technology effective against human diseases. Intellia's main drug right now is NTLA 2001, which is a systematically delivered CRISPR therapeutic. It treats ATTR amyloidosis, a rare disease that causes extreme pain to patients. There are FDA-approved medications that treat the symptoms of the disease, but there is currently no treatment that cures the disease itself. In November of 2020, Intellia made the major milestone of dosing the first patient with NTLA 2001. NTLA delivers to the liver a two-part genome editing system that alters the RNA specific to the disease-causing gene. By changing the gene, NTLA can eliminate the root cause of the disease. On March 30, 2021, the European Commission gave NTLA orphan drug status, which was a huge positive catalyst for the company. Orphan drug status is given to drugs that treat a rare disease that is currently incurable. These rare diseases cause great suffering to patients, but is often uneconomical to develop new treatments. The EU provides financial and commercial incentives to companies developing such cures as to encourage their development. The exact terms of the financial support Intellia will receive have not been announced, but the orphan drug designation nonetheless provided a huge boost to the stock, which has risen about 30% since the announcement. The clinical trials for NTLA 2001 are still ongoing, and it may be years before a full FDA approval. But if it is approved, Intellia can leverage the same technology to make treatments for a wide variety of currently incurable diseases. Intellia is a very early stage company and thus has very little revenue. However, it's still important to look at their financials. We need to make sure there are no red flags that may financially restrict its ability to grow and reach its full potential as a hyper-growth company. First, let's take a look at their income statement. We see that their top line has seen growth in the most recent year, from $43 million to $58 million. That's a 34% increase. Their revenue currently is solely from what's called collaboration revenue, which means revenue that Intellia is paid from fellow pharmaceutical companies Novartis and Regeneron. Those larger companies pay Intellia based on agreements, whereby they make upfront payments for access to future technologies developed by Intellia. Intellia also receives payments when they reach development milestones for their products. This is a really good form of revenue for a company like Intellia, because it means that they can start bringing in their own revenue before they make a fully functioning product. The fact that the revenue is going up shows that they are meeting development milestones and earning the confidence of those two larger companies. The fact that they are burning cash and making a net loss is not concerning at all. They don't have a selling product yet, and the majority of their expenses are research and development costs, which is just investing in their own technology and future earning power. This is an example of where it does not make sense to look at metrics such as price to earnings, because the entirety of the value of this company is in future earnings that are not reflected in the current earnings. Now let's take a look at their balance sheet. The first thing to look at is their liquid assets, especially their cash on hand. This is one of the most important things for a company like Intellia in the short term, because cash is the lifeblood that allows them to continue developing their drugs and building up their future business. Intellia has $160 million of cash and cash equivalents on their books, which is enough cash to fund their cash flows from operations for more than 3 years at the current rate. They also have a large amount of marketable securities, another very liquid part of their assets. On the liabilities side, things look pretty clean. They don't have excessive debt, and in fact only have a manageable $64 million of current liabilities. They have ample liquidity in their cash reserves and balance sheet to handle these liabilities. The single biggest item on their liabilities is additional paid-in capital, which is just money that they have acquired through selling stock. This is like a liability because from a shareholder's perspective, this is money that doesn't come for free. It means that their stock has been diluted to the amount of the paid-in capital. However, this is not like debt, where payments must be made, and interest expense can contribute to the company losing money. So overall, there is no real barrier to growth on their balance sheet. If anything, it looks like they won't have to raise additional capital for the foreseeable future, which is a very good thing for early stage investors. It is extremely hard to put a value on this type of company. There is a high degree of uncertainty as to when their drugs will be approved and how big their total addressable market will be. But with their NTLA 2001 trials already underway and the European Commission giving them orphan drug status, the potential is certainly there. Any investor considering buying this stock should have a very long time horizon of at least 5 to 10 years, as it will take a long time before this company reaches maturity. What do you guys think of Intellia? Are there any other biotech plays you like better? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. WSM Research, signing out.